Bismillahirrahmanirrahim. Assalamualaikum to Sir Amizi and fellow friends. Tonight, our group will be presenting on 2 chapters of Conceptual Framework and 1 past year accounting paper. The first topic to be present will be on the presentation and disclosure, and the second one regarding the concept of capital and capital maintenance. Before going further, I would like to first introduce my group mate, which consists of only 2 members, who is me, myself, and Noriza Sabrina binti Muhammad Azhari, and Nayli Atila binti Jailani. For chapter 7, there will be 4 subtopics that I will be discussed further, which are on the presentation and disclosure as communication tools, presentation and disclosure objectives and principles, classification of assets, liability, equity, income and expenses, and lastly, aggregation. To begin with, presentation and disclosure as communication tools is a reporting entity that communicates information about its asset, liability, equity, income, and expenses by presenting and disclosing information in its financial statement. Therefore, effective communication of information in financial statement makes that information more relevant and contributes to a faithful representation of an entity's asset, liability, equity, income, and expenses, where it also enhances the understandability and comparability of information in the financial statement. In this slide, I mentioned that effective communication of information in financial statements requires A. Focusing on presentation and disclosure objectives and principle rather than focusing on rules. B. Classifying information in a manner that groups similar items and separate dissimilar items. And C. Aggregating information in such a way that it is not obscured either by unnecessary detail or by excessive aggregation. Hence, in making decision about presentation and disclosure, it is important to consider whether the benefit provided to users of financial statements by presenting or disclosing particular information is likely to justify the cost of providing and using that information. Next. Moving on to the presentation and disclosure objectives and principles. To facilitate effective communication of information in financial statement when developing presentation and disclosure requirements and standards, is needed between A. Giving entities the flexibility to provide relevant information that faithfully represent the entity's asset, liabilities, equity, income, and expenses. Where B. Requiring information that is comparable both from the period to period for a reporting entity and in a single reporting period across entities. Presentation and disclosure objectives in standards support effective communication in financial statement, where such objectives help entities to identify useful information and to decide on how to communicate that information in the most effective manner. Effective communication in financial statement is also supported by considering the following principle, which is A. The entity-specific information is more useful than standardized description or sometimes referred to as boilerplate. And B. Duplication of information in different parts of this financial statement is usually unnecessary and can make financial statement less understandable. Next is classification. Classification indicates as a sorting of assets, liabilities, equity, income, or expenses on the basis of shared characteristics for presentation and disclosure purposes. Such characteristics include but are not limited to the nature of the item and its role within the business activities conducted by the entity and how it is measured. Going deeper into classification of assets and liabilities, classification is applied to the unit of account selected for an asset or liability. However, it may sometimes be appropriate to separate an asset or liability into components that have different characteristics and to classify those components separately to enhance the usefulness of the resulting financial information. For instance, it could be it could be appropriate to separate an asset or liability into current and non-current components and to classify those components separately. And then next, similar refers to grouping the similar item. For example, non-current assets such as PPE, building, capitals, and others. Then what is meant by dissimilar is that to separate dissimilar items such as separate asset and liability into current and non-current components. And lastly, offsetting, that indicates where an entity recognizes and measures both an asset and liability as separate units of account, but groups them into a single net amount in the statement of financial position. For example, account receivable. For classification of equity, to provide useful information, it may be necessary to classify equity claims separately if those equity claims have different characteristics. Similarly, to provide useful information, it may be necessary to classify components of equity separately if some of those components are subject to particular legal, regulatory, or other requirements. To illustrate, in some jurisdictions, an entity is permitted to make distributions to holder of equity claims only if the entity has sufficient reserve specified as distributable. Lastly, classification of income and expenses is applied to A, an income and expenses resulting from the unit of account selected for an asset or liability, or B, components of such income and expenses if those components have different characteristics and are identified separately. For instance, a change in the current value of an asset can include the effects of value changes and the accrual of interest to enhance the usefulness of the resulting financial information. Under profit or loss and other comprehensive income, income and expenses are classified and included as either in the statement of profit or loss or outside the statement of profit or loss in other comprehensive income. Next. Many users of financial statement incorporate that the total in their analysis either as a starting point for their analysis or as the main indicator of the entity's financial performance for the period. Because a statement of profit or loss in the primary source of information about the entity's financial performance for the period, all income and expenses are in principle included in the. However, in developing standard, the board may decide in exceptional circumstances the income or expenses arising from a change in the current value of an asset or liability are to be included in other comprehensive income. This is because when doing so would result in the statement of profit or loss, providing more relevant information or providing a more faithful representation of the entity's financial performance for that period. In principal income, income and expenses included in other comprehensive income in one period are reclassified from other comprehensive income into the statement of profit or loss in a future period. However, for instance, if there is no clear basis for identifying the period in which reclassification would have yet result or the amount that should be reclassified, the board may, in developing standard, decide that income and expenses included in other comprehensive income are not to be subsequently reclassified. That would be all from me, and I will pass the floor to Nayli Attila for further discussion on this topic. Thank you.
Thank you, Sabrina. Next, I will continue to discuss Chapter 7 and 8 of the Conceptual Frameworks. First and foremost, what is aggregation? Aggregation is the adding together the details such as asset, liabilities, equity, income, or expenses that have shared characteristics and are included in the same classification. Aggregation makes information more useful by summarizing a large volume of detail. However, aggregation conceals some of that detail. Hence, a balance needs to be found so that relevant information is not obscure either by a large amount of insignificant detail or by excessive aggregation. Not only that, but different level of aggregation may also be needed in different parts of the financial statements. For example, typically the statement of financial position and the statement of the financial performance provide summarized information, and more detailed information is provided in the notes. So in chapter 8, I will present about the concept of capital maintenance, and determination of profit, and lastly the capital maintenance adjustment. A financial concept of capital is adopted by most entities in preparing their financial statements. There are two concepts of capital, which are financial concept of capital and physical concept of capital. The selection of the appropriate concept of capital is by an entity should be based on the needs of the user of its financial statement. Thus, a financial concept of capital should be adopted if the user of the financial statement are primarily concerned with the maintenance of nominal invested capital or the purchasing power of the invested capital. However, if the main concern of user is with the operating capability of the entity, a physical concept of capital should be used. The concept chosen indicates the goal to be attained in the determining profit, even though there may be some measurement difficulty in making the concept operational. Moving on, a financial concept of capital is adopted by most entities in preparing their financial statement. The example of financial concept of capital is the invested money or invested purchasing power. Capital is synonymous with the net assets or equity of the entity. The next concept of capital is the physical concept of capital. If the main concern of user is with the operating capability of the entity, a physical concept of capital should be used. For example, the operating capability. The capability is regarded as the productive capacity of the entity based on, such as the units of output per day. The next subtopic under chapter 8 is the concept of capital maintenance and the determination of profit. Under the concept of financial capital maintenance, the profit is earned only if the amount of the net asset at the end of the period exceeds the amount of the net asset at the beginning of the period, after excluding any distributions to and contribution from owner during the period. Furthermore, financial capital maintenance can be measured in either nominal monetary units or units of constant purchasing power. Compared to the financial capital maintenance, the physical capital maintenance earn the compared to the financial capital maintenance, the physical maintenance earn the profit only if the physical productive capacity of the entity at the end of the period exceeds by the physical productive capacity at the beginning of the period, after excluding any distributions to and contribution from owners during the period. Moving on, the concept of capital maintenance is concerned with how an entity defines the capital that it seeks to maintain. Furthermore, it provides the linkage between the concept of capital and the concept of profit, because it provides the point of reference by which profit is measured. The principal difference between the two concepts of capital maintenance is the treatment of the effect of changes in the prices of assets and liabilities of the entity. In general, an entity has maintained its capital if it has much capital at the end of the period as it had at the beginning of the period. And any amount over and above the required to maintain the capital at the beginning of the period is called profit. Lastly, the selection of the measurement basis and concept of capital maintenance will determine the accounting model used in the preparation of the financial statement. Next, I will discuss about the physical capital maintenance. The physical capital maintenance concept requires the adoption of the current cost basis of measurement. Second, under the concept of physical capital maintenance, the capital is defined in terms of the physical productive capacity. Profit represents the increase in that capital over the period. And all price changes affecting the asset and liability of the entity are viewed as changes in the measurement of the physical productive capacity of the entity. Hence, that is why they are treated as capital maintenance adjustment that are part of equity and not as profit. Next is the financial capital maintenance concept. This concept does not require the use of a particular basis of measurement. Under the concept of financial capital maintenance, the capital is defined in terms of nominal monetary unit. Profit represents the increase in nominal money capital over the period. Therefore, increases in the prices of assets held over the period conventionally referred to as holding gains and basically profits. So the last topic for chapter 8 is capital maintenance adjustment. The revaluation of risk or restatement of assets and liabilities give rise to increase or decreases in equity. While these increases or decreases meet the definition of income and expenses, they are not included in the statement in the income statement under the certain concept of capital maintenance. It is included in the equity as capital maintenance adjustment or revaluation reserve. Next, we will proceed with the past year paper. I will pass back to Sabrina.
Thank you, Nayli Atila. For the past year paper, we could only find question on topic 8 regarding the concept of capital and capital maintenance. The question chosen was extracted from June 2015, question 2A, that stated in current cost accounting, there are two fundamentals and competing views on what constitute beginning and ending capital, the financial concept and the physical concept, by Godfrey et al. The question asks us to explain on the main difference between the concept of financial capital and physical capital, where it consists of 5 marks. Nayli will continue with the answer.
In this slide, it shows you the point to answer the question. For firstly, the difference between the financial capital and physical capital is how it is defined. Financial capital is defined in terms of nominal monetary units. Profit represents the increase in nominal money capital over the period, while physical capital, it is defined in terms of physical productive capacity. Next, how they earn the profit. For financial capital, the profit is only earned if the net asset at the end of the period exceed the net asset at the beginning of the period. Compared to physical capital, the profit is earned if the physical productive capacity of the entity at the end of the period exceed the physical productive capacity of the entity at the beginning of the period. So the last point is how it is measured. Financial capital does not require the use of particular basis of measurement, while physical capital, it requires the adoption of the current cost basis of measurement. That's all from us. Thank you.